Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. This is my second video in my Investing 201 series. And if you missed episode 1, be sure to watch that first, as I'm going to build on some of those earlier concepts, like the 4 investing pitfalls. There's a link in the description below for episode 1 if you need it. Now, today, I'm going to cover why some investors lose 98% while others only gain 3%. How 20 minutes each year can maximize your portfolio success, and the one investing question everyone asks and why it's completely wrong. One of the most common mistakes I see new investors making is betting the farm on one stock, one trade, regardless of how great that stock might sound, how great that company might be, how game-changing the opportunities sound. Never put all your money on one trade. Anyone, or any online community for that matter, who tells you otherwise simply does not understand smart speculation and should not be trusted with your hard-earned money. If you recall those 4 pitfalls from episode 1, unwise delegation could be one of the worst mistakes, as whoever you trust could make their own horrible mistakes. I've seen dozens of images of novice investors losing 90%, 98%, or even all of their account balance because they threw their money into an all or nothing trade. But you also don't want to just buy one share. You still want to give yourself the chance to watch your money grow in a great performing stock. If you're that risk averse that anything more than 10 shares sounds scary, then your best investment might be to just let your bank account interest accrue over time. Simply put, you need enough skin in the game to allow those extraordinary gains to make a difference in your account balance. Unfortunately, there isn't one simple answer to how much should I invest, especially given how diverse people's account size and risk tolerance can be. Some follow the 4% rule, meaning you only put up to 4% of your account in any one position, but others ignore that idea entirely. One general idea to follow with position sizing is the higher the risk, the smaller the stake. I compared your portfolio to your diet in the last episode, and the analogy still stands here. If high risk, high reward stocks are dessert, you just need to limit how much you eat. But there are also very few people who leave that 5-star restaurant without at least trying the dessert. Balance is the key here. Don't pay more for dessert than your main course. That can make for a very one-sided and unappealing meal. With thoughtful position sizing and proper asset allocation, you can avoid the first 2 pitfalls I mentioned in the last episode, being too conservative or being too aggressive. Now, a lot of people forget it's not just about the size of your initial investment, it's also about the percentage of your portfolio that position becomes. If your stake grows, that's great, but you need to be mindful that your position could now be overweight in your asset allocation. So what you need to do is called rebalancing your portfolio. Rebalancing is the process of selling a portion of an appreciated asset and investing the proceeds into an underweighted asset class. This helps you restore your original asset allocation, and don't worry, yearly rebalancing takes less than 20 minutes, it's not complicated. For example, let's use an asset allocation that is, say, 30% US stocks, 30% international stocks, 30% bonds, and 10% alternative assets. For a $100,000 portfolio, the original allocation would be as follows. Let's assume at the end of the year, the portfolio value is now $140,000. Nice work, you got a $40,000 gain. You can see on the screen that as US stocks grew, so did their percentage of your portfolio, now at 35%. The inverse is true with international stocks, which now sit at only 21%. These new values aren't a problem right now, but they could be. More of your funds would be at risk if US stocks took a tumble, while less of your wealth could grow if international stocks went on a tear. Remember, the key here is optimizing your portfolio for maximum gains and minimum risk. We don't want all of our hard work in building this strong collection of diversified assets to go to waste. This is especially true because the situation is so easy to fix. To rebalance this portfolio, you'd simply have to sell $7,000 of the US stocks and $5,600 of bonds, and thereby reallocating $12,600 to international stocks and returning the portfolio, this is key, to its original asset allocation percentages. And what's more, this strategy doesn't just hope to buy low and sell high, it forces you to actually do it. That's a good thing. If you didn't rebalance, you'd be buying more of an appreciated asset in the hope that you could sell it at an even higher price in the future. And if you recall, failing to time the market is the third major pitfall. So rebalancing is a great tool in your arsenal to avoid buying high and selling low. Now, it's worth noting that rebalancing is for asset classes, not individual stocks. You should only sell a stock for one reason and one reason only. Your sell strategy demands it, whether that's a trailing stop or a price target or a percentage gain, whatever your system is, stick to it. Sell too early and you miss out on gains. Sell too late and you lose more of your money than you need to. You left profits on the table. So do not let the media or nerves or hope keep you from selling outside your exit strategy. Buying is flashy and fun, but selling is arguably a more important and costly process. So far, we've gone back over what goes into a rock-solid diversified portfolio and how to properly size and manage your positions. But the larger question still remains. What should I buy and which stocks are good stocks? This is the question that took me more than 2 decades working in finance and recommending trades to answer. It might surprise you, but the answer is that's the wrong question to ask. You might as well ask a meteorologist what their favorite weather is. Those answers won't help you plan your day in the slightest. You need to know when it will rain, not if they like the rain. So with investing, it's not so much what, but when should I buy and how do I find the best stocks? Almost any stock could be a buying opportunity at some point in time. The key is to find out when to buy to maximize profits. My investing philosophy has been to look for companies that are innovating with strong management, consistent and increasing revenue and profits, all the metrics for a healthy business. But even then, finding the best buying opportunities requires more than looking at product releases and Yelp reviews. Apple is a consistent innovator, but even one day's difference could separate okay gains from extraordinary gains. That's why timing is equally, if not more important when it comes to investing. You need a system to follow that gives you clear buying signals, alerting you to exactly when to invest your money. Systems that look for insider buying, or waiting for a momentum formula to cross a certain threshold, or seeing when institutional investing takes place, or all three. These metrics can whittle down the thousands of listed stocks into a simple yes or no. And it's that kind of calculated, emotionless decision-making you need when investing. Simply put, investing systems help you avoid the 4 pitfalls. And part of the reason people gamble their nest egg on one stock is their emotions override whatever processes they had in place. And whether it be greed or fear or excitement, you need to push those aside when choosing the stocks to buy. And this is known as behavioral finance and can be really harmful to your bottom line. Let your investing system decide for you and follow those clear buying signals and disciplined stop losses to guide your entry and your exits. It sounds simple in theory, but in practice, it can be a little complicated. And part of the reason these groupthink online investing communities have gained such fervor is that some people don't have the time to develop strategies on their own. They don't have the time or the expertise, and it can be alluring to get a ticker symbol from a keyboard warrior and think you found the shortcut to being a millionaire, even if you have no idea why you're buying. Buying and holding a stock just because it's been going up, even if it's been going up for a long time, is not necessarily a prudent strategy. Back in the 1970s, there was a list of 50 stocks that led the bull market early that decade. They were even called the Nifty 50. And people thought if you just bought and held them, the gains would go on and on forever. And some companies actually did well. Companies like Anheuser-Busch, Coca-Cola, McDonald's, others not so much. When's the last time you heard someone talk about investing in International Telephone and Telegraph, Louisiana Land and Exploration, or MGIC? History shows us that forever is a long time, and an even longer time when talking about investing. So there is no shortcut to millionaire status when it comes to investing. Nobody gives away winning lottery tickets for free, and lists of best performing stocks will become outdated sooner or later, usually sooner. The active systems I have in place in my own account took years to test and develop, and even then, sometimes they need adjustments, continual tweaking. No strategy is perfect, and anyone who tells you they are is kidding themselves or you, or both. But there's a way to get the best of both worlds, an ideal combination of quality investment research, avoiding those pitfalls without the years of work and struggling to get there, all while spending less than a nice dinner for two at a restaurant. And I'll tell you more about it in the next video. Until then, this is Alexander Green. Thank you for watching, and we'll talk again soon.